So today I want to talk about another relatively cheap option strategy that could net big returns. Now this is a neutral to bullish option strategy. So in other words, you want to find a stock that you're neutral or bullish on, okay? So in other words, you think the stock is either going to trade sideways or it might go up a little bit in price. So what I'm going to do here today is I'm going to use this stock right here, AT&T, ticker symbol T, to show you guys an example of how this works and how you set it up. Again, this is just an example. This is not a real trade, not a real alert. Do not copy this exact same trade I'm going to show you. Now, one other thing I want to mention here, you do need level 3 options to use this strategy. I get a lot of people that ask me why I don't talk more about level 2 options strategies. Keep in mind, level 2 is very limited. All you really have is buying calls, buying puts, selling covered calls, selling cash secured puts. It's literally it for level 2 options. Not a whole lot to talk about there, okay? So you do need level 3 options for this. So with that being said, let's go into the options here for AT&T. And a reminder, you want to be very careful with early assignment risk here due to the ex-dividend of a stock. So remember, you want to check, does this stock have a dividend? AT&T does. When is the ex-dividend date? You want to avoid selling options on the week of the ex-dividend date so that you don't get early assigned due to that ex-dividend date. So here we are in the options. First thing we'd want to do here is select the appropriate expiration date. So here I can click on this drop down, and as you can see, it's going to give me a lot of different options here. So again, what expiration date you choose really dependent on your situation. What I would say though, me personally, when it comes to strategies like this that are a little bit more, neutral strategies, I generally like to not go too far out, because the further you go out, the more uncertainty there is, the more things could happen that could really cause the stock to really go up or really go down, right? Instead of staying neutral or not really moving a whole lot. So generally I like to stick with closer expiration dates here, but again, it's dependent on your situation. Now I'm going to go ahead and just select June 30 here for today's example. So 11 days until expiration date here. And so now we're going to go ahead and get into actually selecting what options we want to select. So the very first thing you want to do here now is you first want to switch over to puts here, because we're going to be dealing only with puts today. And the next thing you want to do is you want to determine what price you believe this stock will be at on expiration, or whatever stock it is that you're using. What price do you think that stock will be at on expiration? So again, let's say for AT&T, let's just pretend I believe that at expiration it will be at $17.50, right? So not a lot higher than it's currently at right now, but it would move slightly up. So let's say I think it's going to be at $17.50 at expiration. So what I would do is I would start by switching over to sell now here. And I would start by selling 2 puts with that strike, or the closest strike to that price that you just came up with. So again, if I think it's going to be at $17.50 at expiration, I would start by selling 2 puts at that strike, or the closest strike to that. So there is a $17.50 strike. So I would go ahead and select here. And then I would go ahead and modify this to sell 2 puts, not just 1 put. And I'll show you guys where you would go to do that here. So we're going to be selling 2 puts here. So now we're going to switch over to buy here. We're still going to be looking at puts, but now we're switching to buy. So now we want to go ahead and buy a put here with a higher strike than the strike of the puts that we're selling. So basically, 1 put up here. I'm just going to go to the one right above it at the $18 strike and buy this put right here. So now we want to go ahead and buy another put here. But this one needs to be very specific, okay? If you don't do this, it may not look the same. It may not be the same strategy I'm showing you here. So now what we want to do is we want to go back to the puts that we're selling, and we want to go down now. We want to go down twice the distance between the strikes of both of the puts that we have selected so far. And we also want to buy that put. So here are the two puts we've selected so far. What is the distance between these two strikes? It's 50 cents. So we want to get twice that distance. So 50 cents, twice that, is going to be $1. So in other words, we want to go down $1 from the puts that we're selling and buy that put. So here's the put that we're selling, $17.50, $1 down would give us the $16.50 strike. So we want to buy this put here. Very important that we do that, okay? And so now the last thing we want to do is we want to come back up here, click on this little icon, click on custom here, and then remember for the put that we're selling, we want to sell two, not just one. So let's go ahead and modify this to 2 here. And so ultimately here, you want to make sure that you're entering for a credit, which we are in this example, right? We'd be entering for a credit here. You know, looks like maybe a $10 credit or so. We want to be entering for a credit. And so now you can take a look down here at what this is kind of look like. But basically, again, you know, it's going to be kind of a neutral strategy because, you know, as long as the stock doesn't move a whole lot, we're going to make some pretty good money. But we're also going to be able to make money to the upside here. So if this stock completely explodes, we can also make money here. And so since we're entering for a credit, you know, we're going to have to put up some collateral here, as you can see, $50 for this example here. So now that being said, let's first head on over to Option Strat to visually take a look at what this would look like depending on, you know, the share price, the date, implied volatility, all of those things here. So let's go over to Option Strat here. So here's Option Strat. I'll put a link to Option Strat in the description below. Really great options visualization tool. Let's go to Build here. And then let's just start with regular puts here. And so let's go over to ticker symbol T, AT&T. The expiration date I selected was June 30, so it's already selected there. So again, right, the first thing we did was we determined what price we believed the stock would be at on expiration. I said, let's just pretend I think it's going to be at $17.50. So I said, okay, we need to sell 2 puts at that strike price. So there's the $17.50 strike. We want to sell 2 here. So now we have 2 here. Then I said, okay, now we want to buy a put here with a higher strike than the strike of the puts that we're selling. So I said, let's just do the one right above at the $18 strike, and we only want 1 put here. Finally, I said we also want to buy 1 more put, but now we want to go back to the puts that we're selling, and from here, we want to go down twice the distance between the strikes of both of the puts we have selected so far. Twice the distance is $1, so $1 down from the $17.50 strike is the $16.50 strike. So that would be this one right here. And so now, right, we have exactly what we're looking for. So we take a look here, right? Like I said, we want to be entering for a credit. Here it says $43 of credit. That's probably more accurate than what Robinhood said because I think the bid ask is a little bit wide here. But again, you want to be entering for a credit regardless here. Now we take a look here, max loss, $7. That's the most you can lose. Max profit, $93 here. And then we have our break even. So if we zoom out here, right, we get a little bit better visual here, you know, as to what this looks like here. Now, couple of things here, right? Number one, the ideal situation here is that at expiration, the price of our stock is the same as the strike of the puts that we're selling. So in other words, for this example, we want AT&T at expiration to be at 1750. If it is at 1750, that's exactly where we're going to make our max profit here. However, as you can see, even if it doesn't get up to 1750, if it's below, we can still make some money, as well as if it explodes, we can still make some money here, right? So neutral to bullish option strategy. Now, the other thing I want to mention here is we can close out of this at any point in time. So let's say Wednesday comes and AT&T is up to 1660 and you're up 18 bucks, right? At that point, you can close out of this. You can take your $18, close out, make some money. You don't have to wait until expiration to close out. You don't have to let it expire. You can close out at any point in time. And lastly, changes in implied volatility here. So let's take a look here. Let's say IV goes down, right? You can kind of see what starts to happen. 5E goes up. We can also kind of start to see what starts to happen, right? So just looking at this very quickly, looks like we would want IV to go up here. We start to see a lot more green when IV goes up. So always take a look at what happens with changes in IV. So anyways, if you guys have any questions, feel free to leave them in the comment section below. Check out the Discord, a link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.